Hi there. Welcome back to yet another episode of E.M.I. That's Economy, Markets, and Investments for you. This is the E.M.I. for the month of March. Let's jump right in. In this month's E.M.I., we ask three key macro questions. First, we ask where does India stand now in the business cycle? How timely has the RBI's policy easing and the government's fiscal support been? And most importantly, what are the key supports, rather enablers, for India growth in the near and medium term? These are the three questions that we're trying to address in this month's E.M.I, alongside investment narratives and market narratives. Where does India stand now on the business cycle? Now, it might look a little confusing to look at this chart, but trust me, it's fairly simple. How do you read this chart? Follow these light gray lines in the clockwise direction. So the light blue dotted line that you can see here are pre-COVID growth phases, and the dark blue dotted line, curved dotted line, is a post-COVID phase of growth. Now, what are these lines? This is the OECD's CLI. The CLI index of OECD, this measures India growth on a month-on-month basis. A monthly momentum can be built based on this index. This sort of helps us visualize the economic momentum through these four stages. What are these four stages? It starts with a recovery, and it goes into an expansion, then into a downturn, and then into a slowdown, back again into a recovery. This is how you read the chart. It might take some time to get accustomed to read, but it gives a very good sense as to where we are on the business cycle per se. So April 2017 is when you start the pre-COVID phase in this chart. It starts here. We are in a recovery, and then we move into an expansion by December 2017, and by December of 2018 we're here, just entering into a downturn, and then you go on till December 19, and just before COVID hit, we were here. You can see the marker on my screen. This is exactly where we stopped just pre-COVID. We were just in the end of the slowdown and planning to get into the recovery phase again. Where were we 9 months after COVID? So the 9 month period we've omitted here. Otherwise, the screen will be too confusing and too messy. So we started after 9 months of COVID. We started from November of 2000. Where were we? We were in an expansion phase thanks to all the targeted government measures. We were starting off in November of 2000. By November 2021, we were just entering a downturn. And then by November 2022, we crossed the downturn, entering a slowdown. And then by November 2023, we are out of the slowdown into a recovery. And from November 2023 till July 2024 was an expansion phase. And now this is the most important part. July 2024, where what bell does that ring? The general elections. And after July 2024, you had a very sharp drop in capex. Capex pickup did not happen. And all the way from July 2024 until November 2024 was largely a lull in economic activity to a certain extent, given that capex did not see a sharp pickup. Post November 2024, capex has started picking up. And the OECD CLI index tells us that we are somewhere here. As of February of 2025, we've crossed the downturn, we have just entered a slowdown. This is how the OECD CLI index plots India. It's very important to notice here that the phase that we talked about first, that started April 2017 to February of 2020, which was pre-COVID, it was a fairly large economic cycle where you saw a fair bit of an up and a down there. It ranged between 98.5 to 101.5 on the OECD CLI index. Post-COVID, though we saw a cycle, a business cycle of sorts, remember here that the range that the OECD CLI has been working within has been a very tight range, 99.5 to 100.5, a very tight range, which is also the reason why we've been commenting in all our dailies and our weeklies and our monthlies about how India economic growth has been holding up. It's been in a tight range, but it's been holding up. That is something that is reconfirmed in this business cycle chart of OECD CLI. Let's now go into something that is a little simpler. So now in this chart, the key takeaway is that India growth, the India business cycle has been in a tight range post-COVID. And the CLI index appears to be telling us that we are in some sort of a slowdown. Probably the reason why the government and the RBI thought it fit to come out with a lot of announcements and action. Now, the same chart that you saw in the previous slide that we had portrayed in a 4-quadrant graph, we are putting that out in a very simple manner. The same OECD CLI. This is the recovery, the expansion, the downturn, the slowdown, the recovery, expansion, the downturn, the slowdown. This since 1994. We have also plotted the points where the RBI starts cutting rates. So you can see that most of the time the RBI cuts rates, it is below the 100 phase. You can see, or it's this entire phase where you see most of the green dots coming. And February of 2025, which is an important date, you can see a green dot there. It does look like the RBI action and government measures appears to have come at a very key, crucial period of time, rather you can call it in the nick of time. You've seen action from both the government and the RBI to help India growth prop up and India growth boost going forward. So, two key chart pointers from these two charts. First, the OECD CLI index appears to be telling us that we are here on the business cycle, and all these measures are likely to help India growth move higher from here, and we will probably cross this slowdown phase at a much faster pace. This tells you that most of the RBI cuts in the past have always been delivered when the OECD CLI index has been in and around that 100 mark, or rather largely below the 100 mark. This time around, the OECD CLI index is just under 100 and the RBI has already delivered a rate cut. This rate cut cycle has started. And now, what are the key positives that one should be looking ahead for? There are 5 key near-term supports, or rather a near-term enabler that India has going forward. In order of importance and also in order of chronology, what we saw July 2024, capex did not happen. Central government capex did not happen. State government capex also had taken a hit. From December of 2024, we have seen an appreciable pickup in capex and quite a sharp pickup in certain segments, certain ministries. Second, in February, we saw a very appreciable effective tax rate cut delivered by the Honorable Finance Minister in her Union Budget speech. And then following that, we had the RBI start its rate cut cycle and really give a cheer to the markets, indicating that they were shifting to a pro-growth narrative. What reiterated that pro-growth narrative was a rollback of the risk weight increase that the RBI had imposed on banks lending to NBFCs. So soon after the policy, you saw RBI cut back the risk weight that they had imposed in November of 2023 on banks for lending. And all through from the CRR cut that was delivered in December of 2024, even until currently, as we speak, more and more FX buy-sell swaps, more OMOs, more liquidity infusion into the system that has brought down domestic liquidity deficit from nearly 3 lakh crores plus to just in and around and probably below 1 lakh crores of liquidity deficit. All of these have been very key enablers for growth in India and will continue to remain very important enablers going forward. So the two charts here talk about how the RBI actions way from December of 2024 have led to the liquidity deficit bottom out, and from nearly around 3.3 lakh crores of liquidity deficit, we are moving closer to just about a 1 lakh crore of liquidity deficit. And the second chart here talks about why a reversal of the risk weight increase on banks that was done in November of 2023, a reversal of that could really be a positive support for credit growth as such. So the chart here talks about credit growth year on year and how you've actually seen the bank credit to NBFCs come off sharply when the RBI increased the risk weights on bank lending to NBFCs, and the contribution of this bank lending to NBFCs, how that contribution also came down quite sharply from 15% plus to around a 6.3% plus after the risk weights were increased in November of 2023. So when this reversal happens, one can't argue that it will go back exactly to where it was before November of 2023, but nevertheless, one can be rest assured that this will definitely act as a positive support for credit growth as such. Now, these are the 5 key pointers. Now, there's one big pointer that is yet to happen, a sixth growth booster that can be added to the mix. This is the eighth pay commission. So, pay commissions happen once in every 10 years. The last pay commission was in 2016, which is why markets expect the next pay commission to be in 2026. Early 2026 probably is expected to be the eighth pay commission. Implementation is likely to be from January of 2026. If one goes by the growth rates we saw in the pay and expenses of the seventh pay commission, if you go by the same assumption, it does appear to tell us that somewhere in the range of 800 billion or 80,000 crores of incremental pay and expenses are likely to be seen under the eighth pay commission. And if one actually also simulates the same growth rate for the pension bill, it appears to indicate that the pension bill would go up by 99,000 crores or so. Whether this will be implemented immediately or in a phased manner over a period or over a couple of years, we don't really know. But the fact of the matter remains is that the eighth pay commission can give an appreciable boost in addition to these 5 factors that we mentioned from an economy support point of view. Now, the usual set of 4 charts that we always talk about. First, we're looking at thermal generation. Note here, all these numbers are in absolute terms. They're not year-on-year or transformations. As of FY25, we are here almost exactly tagging the movement that we saw in FY24. No significant growth there, but sort of holding up. Your new residential apartment sales for the top 7 cities, they appear to be well below their FY24 levels. But note here that FY24 is not a normalized level. We are well above FY19. FY24 saw a significant boost. So one can read this as a sort of normalization from elevated levels. Gold imports have come off, have seen a fair bit of a drop from their extremely elevated levels a few months ago. Port traffic has seen a sharp pickup, probably in anticipation of tariffs. So that appears to be one key reason why one could have seen a very sharp pickup in activity, port activity, as of the month of January 2025. We now move to the next segment, markets in February. The key highlight in the month of February was the rally in gold. We wrote about the rally in gold last year as well, but we felt it was important to reiterate the same at the start of this year. There are 4 rallies in gold. The first rally, it saw around a 14% rally in gold. The key driver was Israel-Hamas war and concerns around geopolitics. The second was driven by China buying. The third rally was driven by Federal Reserve rate cut expectations. And the last rally was US tariff uncertainty. Now, what was this US tariff uncertainty? The rally that you saw in gold from probably mid-Jan to all through February was linked to the US tariff uncertainty that led to a fair bit of a jump in US derivative trading, and that led to a sharp demand for underlying gold, for the derivatives. That appears to be the key reason behind the 4th rally in gold. This is a narrative that we've spoken about earlier. Under the current presidency in the United States, under the President Donald Trump, it does appear fair to expect that the geopolitical premium to gold could probably be lesser in 2025 because Donald Trump is generally seen to be not pro-wars, not pro-uncertainty on the geopolitical front. So it seems reasonable to expect that the war narrative in Europe and in the Middle East would definitely not see an exacerbation. That would then mean that the entire structural rally in gold can then be related to 2 key pointers. First would be Federal Reserve rate cuts, and second would be any tariff narratives or concerns from tariffs. Coming back to gold, one very important number that you need to keep in mind is how much central banks consume gold, central banks demand for gold. The last 3 years, 2022, 2023, and 2024, in every single year, central banks as a whole have bought more than 1,000 tons of gold in every single year. This is the 3rd year running where central banks have bought 1,000 tons and more of gold. So if we break up gold as gold demand and see how much of this comes from central banks, you can notice that the last 3 years, 20% plus of demand comes from central banks. To an extent, that also explains the China rally that we saw in early of 2024, where gold was driven by the China rally, the second rally in gold that we spoke about a few minutes ago. 40% of gold demand comes from jewelry, around 7% from technology. After central banks and after jewelry, investment appears to be the next big item that demand for gold comes from. Why is there so much of demand for gold? If you plot gold purchases in tons, India's gold purchases in tons, you can do this for any other central bank as well. You would probably see around the same time gold demand starting to inch up. Gold purchases and US 10-year yields moving higher appear to sort of move hand in hand directionally. It's not exactly point to point, but you can see the directionality here. And the logic also appears to be sound, given that roughly around 38% of India's currency reserves are held in US treasuries or in US dollars. So when you see US yields move higher, you will see currency reserves contract just because of mark-to-market losses. And if you see US treasury yields move down, you probably will see mark-to-market gains as well at buoy forex reserves or currency reserves in India. So from the post-COVID period here, when you started seeing US spend a lot on the fiscal, US Fed balance sheet start increasing, US yields started moving higher, that started leading to mark-to-market losses for emerging markets on their forex reserves, and it made only sense for them to start diversifying their portfolio and add more and more gold onto their portfolio. So central bank demand for gold that was around 8 to 10% pre-COVID has nearly doubled, more than doubled to around 21%. It's more than doubled over the last 7 years. We now come to markets. One key standout from an equity market point of view, when you look at USD-based MSCI equity indices, was how India's equity return, India's is the orange line in here, came off well below US market returns and marginally also below your world developed market returns, just above world returns. But nevertheless, it is important to note that against emerging market returns, India still, even after this drop, India still stands well above emerging market returns. DII inflow momentum into the equity markets continued. FII flows remained in the sell-off mode, but DII flows continued into the month of February and remains well above what we saw in the last few years. Large, mid, and small cap valuations, they continue to moderate. And one very important observation we saw when we did our monthly market insights was the gap between Nifty earnings yield and bond yield. Remember here, Nifty earnings yield is nothing but 1 divided by PE. That gives you somewhere around a 5.5% for Nifty earnings yield. Bond yield is around 6.7. So the gap between the Nifty earnings yield and the bond yield is around 1.2%. The long-term average for this gap is around 1.4%, which is sort of indicating to us that we're somewhere in this phase of the cycle, probably where one would see valuations normalize, and given that valuations continue to normalize, you will see the gap between earnings yield and bond yield contract a bit more. And as they contract lower, there will be a point in time where the markets realize that they probably find India an attractive investment destination all over again. Remember here that as we read and as we also see in data, FIIs continue to remain underweight India, which one can argue is a positive from a medium short term for India as such. The last segment, what must you know before investing? We spoke in the last E.M.I for the month of February about SIP investing and what the probability was to get 12% returns. We now speak the exact opposite. How frequently do SIPs underperform this 12% target? That is the most important. We've been talking for a while now about is that important time frame below which you should not have an SIP. If you have an SIP, your SIP should be at least 7 years. And the logic that we gave was that historically, there is a 0% probability of you losing your money, your capital, if you have invested in the market in an SIP for a 7-year period. Now we see what is the probability of getting less than 12% return at that same 7-year SIP time frame maturity. 30% probability of you getting less than 12% XIRR in your SIP return, even if you invest for a 7-year period. Then what do you logically do? The longer you have your SIP, the probability of getting lower return, lower than 12% return, keeps reducing quite sharply to such an extent that if you run a 21-year SIP, there is a 0% probability that you get less than 12% return. Rather, put it the other way around, there is a 100% probability that you get 12% and more percentage returns if your SIP is more than 20 years. Now we come to the most important aspect. Let's assume you are a 7-year investor or an 8-year investor or a 9-year investor. The markets are not very favorable at a point in time when you want to redeem your SIP. What do you do? So let's say your redemption date for your SIP is next month, and the XIRR that the SIP is giving you is less than 12%. What do you have to do? We take 4 key time frames here. We take the example of a 7-year SIP, a 10-year SIP, a 12-year SIP, and a 15-year SIP. So this would be the 7-year, this would be the 10-year SIP, this would be the 12-year, and this would be the 15-year. Now, how do we read this chart? The light blue line is your rolling SIP return over the years. So let's say this starts in November of 2006. What was your SIP return then? XIRR for a 7-year SIP, it was 30% and plus. Remember, last month we talked about what the unluckiest and the luckiest SIP returns were. If you haven't read that, please take a look at that E.M.I for the month of February as well. That will give a better context before we get into this slide. So your SIP returns, 7-year SIP returns, are very well above your 12%. But as you reach mid-November of 2010, you start noticing that your SIP returns, 7-year SIP returns, are well below this 12% target range. Now, what do you do if you're at the time when you are redeeming your SIP, 7-year SIP or 10-year SIP or 12 or 15-year SIP, if your SIP return XIRR is less than 12%, what do you do? So in this phase, post GFC period, if you had continued your SIP for another 28 months, extended your SIP for another 28 months, your return would have come back to 12%. That was the worst outcome. The best outcome was probably just 2-3 months addition to your SIP. The second phase of the market, which was post 2013, data tells you that if you were an investor who got less than 12% returns when you were redeeming your SIP, all you had to do was extend your SIP for 13 more months and you would get back to 12% returns. And the post-COVID cycle, it gets even better. If your return was less than 12%, your SIP, 7-year SIP return was less than 12%, you had to just continue your SIP for another 10 months and your return would get back to 12% XIRR. The same thing we do for 15-year SIPs, for 10-year SIPs, 12-year and 15-year. You notice here that the longer you increase your SIP, so this is the shortest SIP, 7-year in this chart, and this is the longest, which is the 15-year SIP. You notice here that the periods where you have to intervene and continue your extending your SIP becomes smaller and smaller because the probability of getting less than 12% return also keeps shrinking. So 2 key pointers from this month's what must you know before investing? First, increase your SIP time frame to almost reduce your probability of less than 12% return. That seems a logical conclusion. But the most important takeaway here is when you are redeeming your SIP, if your return is less than 12%, all you will have to do is on average, somewhere close to 10 to 12 months on average, if you extend your SIP to get back to 12% returns. That's all for this month's E.M.I. And like always, we end with a quote. And this time the quote is from Confucius. And he says a man who does not plan long ahead will find trouble right at his door. Stay invested. Every market correction, if you are a long-term investor, is always an opportunity to add on and create wealth. Till next time, this is Arjun signing off. Have a lovely month ahead.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.